Major averages trying to regain their post-election momentum this week, and they did, kind of. The Dow, the S&P, and NASDAQ all locking in weekly gains of more than 1.5%. The Dow also setting, as we've been talking, a fresh record close today. But where do they go as we enter these last few weeks of the year? Let's bring in Bleakley Financial CIO Peter Boockvar, also a CNBC contributor. Peter, welcome. You talk a good bit about this being a two-lane kind of economy. What does that mean, and what does it mean for the equity markets?
Well, we have a fast lane that includes upper income spending that's robust still, helped by not just income, but the wealth effect of higher home prices and stock prices. You have anything related to AI spending, and you have anything related to government spending. In the slow lane, you have the lower to middle income consumer. You have manufacturing that's in a 2+ year recession. You have the pace of housing transactions and everything related to it at the slowest pace in 30 years. And you have global trade that is rather muted. So while we see the GDP number in the aggregate running, call it 2.5%-ish, I think it's much more mixed under the hood.
When you've got interest rates, the market interest rates on the 10-year and others at the levels at which we find them today, is that going to make it harder, given where stocks are valued, for stocks to move higher?
It's a great question, because I do think that that is the biggest challenge. We have what I believe is a bond bear market that started a few years ago after a 40-year bull market. And I think we're just still adjusting to this rather sharp rise in interest rates in a very condensed period of time. And it's not just in the U.S. I see the Japanese 40-year bond yield closed at the highest level since 2008 this week. European yields are off their highs, but they have ticked higher. So I think there's this global rise in interest rates that will continue, notwithstanding central bank attempts to lower short-term interest rates. The most notable market thing that has happened over the last couple of months has been the sharp rise in interest rates in the face of the Fed lowering short-term interest rates by 75 basis points.
Tim has a question.
Yeah, hey, Peter, how about notable in the dollar's move, and what does that do for your view? You're someone that looks around the world, too. I mean, there are people that have been talking about Spain as a great market, the best market, certainly the best economy across Europe. But dollars moved 7.5% really since yields started moving higher. And now there's probably a U.S. dollar EU differential that's economic based upon differentials on central banks. So I'm just curious what you think either the dollar means to multinationals here, or where the opportunity from this dollar is for multinationals that get better and more attractive here.
Well, the dollar action is interesting because, yes, it's rallying against the euro, the pound, the yen, and some others, but it's weakening against the price of gold. So is the dollar really strong, or is it weak, or is it just the better of other fiat currencies? With your point about Europe, well, we had pretty disappointing PMIs today, both on the manufacturing and services side, on top of expectations that then got built into the December ECB meeting, where we're now pricing in about a 50% chance that the ECB is going to cut 50 basis points. The ECB now, while their mandate is inflation, it's clearly shifted to the growth side, which is not their mandate. It's more of their unofficial one. But they're cutting the Fed, maybe not in December. It's 50-50 there. And that accounts for that weakness in addition to that economic weakness. The dollar, generally speaking, we know it's challenged. It's challenging the yen because the BOJ won't raise interest rates in the face of persistent 2% inflation. And to your question, what it means for earnings, it's going to be a headwind for multinational earnings if this dollar stays strong as the quarter progresses. But also, it's a liquidity suck if the dollar continues to rally, which the market obviously has ignored up to this point. But if it continues, I think it will get some attention.